Oui, j'ai parti le... On attend la confirmation de notre régie à HEC et nous serons prêts à partir. Oh. Donc, je vous confirme que nous sommes revenus en live après tout ce moment d'attente. Nous sommes vraiment désolés. Les participants, êtes-vous prêts à débuter votre présentation finale?
Bien sûr.
So, not belong. Do you prefer the instruction in English or est-ce que vous préférez les instructions en français?
En français, ça a été.
En français, parfait. Bienvenue, bonjour à la présentation du cas de finances corporatives. Je vous lirai les instructions de la présentation pour ensuite laisser les juges se présenter. Vous disposez de 20 minutes afin de présenter votre solution au juge. Le temps commencera à s'écouler dès que vous débutez votre présentation. Je vais vous montrer le temps restant à l'aide du clavardage lorsqu'il restera 10 minutes, 5 minutes, 2 minutes et 30 secondes. Vous pouvez également suivre le temps sur le lien coucou qui sera envoyé dans le clavardage. Le jury ne peut pas vous interrompre durant votre présentation. Suite à votre présentation, vous serez envoyé, vous allez rester dans cette page-là. Le jury bénéficiera d'une période de questions de 10 minutes afin d'éclaircir certains éléments de votre présentation. Veuillez noter que lors de la période de questions, si un membre de l'équipe est en train de parler lorsque le temps est complètement écoulé, il sera autorisé à terminer sa phrase. Je vous demanderai qui est-ce qui va présenter le PowerPoint ou le Google Slide parmi vous trois.
Ouais.
Parfait. Donc, on va te donner accès pour que tu puisses présenter, Benjamin. Je laisserai donc les juges se présenter par la suite et vous pourrez débuter. Bonne présentation.
Bonjour à tous, bon après-midi. Mon nom c'est Maxime Caron, je travaille chez Équipe Capital en trésorerie et en tarification.
Bonjour, je me présente, Carl Jobin-Chaud, je travaille comme directeur de compte également chez Équipe Capital et je m'occupe de la région de l'Ontario.
Bonjour à vous trois, mon nom est Antoine Bouchard, consultant en infrastructure et économie chez KPMG.
Bonjour à tous, très content d'être là.
Je partage mon écran.
Bonne chance.
Merci. Merci.
Donc, nous allons partir le temps dès que vous avez débuté à parler.
Bonjour à vous, membres de... Oh, je pensais que le PowerPoint était parti. Pardonnez-moi, je suis trop excité de commencer.
Et quand t'es prêt.
Bonjour à vous, membres du comité exécutif de la firme CorpoFinance. Je présente mes collègues Benjamin, Léo, ainsi que moi-même, Étienne, de la firme conseil EBL. Aujourd'hui, vous nous avez mandaté pour résoudre votre problème d'acquisition d'un centre d'achat commercial en s'assurant, bien sûr, que les achats de ce centre commercial et des actifs seront centrés vers votre puissance et pour grandir dans les années futures. Notre présentation se fera en anglais, mais ça nous fera un grand plaisir de répondre à vos questions en français ou en anglais par la suite. So how we're going to kick us off is going to be through the industry overview, and then we're going to go through each of one of the mandate. And then at the end, we're going to show you how merge together the implementation of our strategy. So prior to starting off with the mandate, I will kick us off with the introduction by Benjamin.
Perfect. Thanks, Etienne. So just to start with the overview of CorpoFin. So your business started 15 years ago in Vermont. It's a family business that was created by you as brothers. So what is CorpoFin? It's a business that operates in the northeastern US. You specialize in operating and leasing spaces in urban shopping centers, as well as building condos. As you can see on the little chart at the bottom, your revenues have been growing over the past year, and your margins are a bit declining, but relatively stable and healthy. In terms of your need, the main challenge for you currently is the political instability and the new regulations in the US. So your first need is to diversify your cash flows, and the second need is to find a rapidly growing area. So the opportunity for you today is to expand your operations in Canada by acquiring the company Polaris. So just before starting with Polaris, we're going to do a brief overview of the Canadian retail industry. So the first thing is the competitive rivalry. Competitive rivalry, it's basically the number of brick and mortars is declining, so it's not too strong. In terms of bargaining power of tenants, there's less places for them to go. In terms of threat of substitutes, this is extremely high. The main reason is the e-commerce that's growing and the new retail technologic advancement. In terms of threat of new entrants, there's the new brick and mortars that are becoming more rare. The new entrants are more new companies, maybe only online or other type of companies. And in terms of community acceptance, this is going to be a very important part of the presentation. We're going to talk to you more about this with the Polaris Center overview. So what is Polaris? It's a business that was created by a family 50 years ago. So what is Polaris Center? Basically, Clemence Laprise that built a mall on a land that she inherited from her father, Julien. Clemence worked long hours to get her business off the ground. And as you can see with the chart at the bottom, the revenues for this business have been growing over the past year, and the margins are also growing and very healthy. But something very important about this company is the values. The first value is family. This is because the father worked all his life to cultivate this land. So it's really a land that belongs to the family. Second value is the community. Every Sunday night, you organize boot hockey games in the parking lot. And the final important value is the financial discipline, because this company has no mortgage, and Clemence is very good to plan all the expenses. So I will now pass it on to Leo for the first mandate.
Yeah, thank you, Benjamin. So you tasked us with 3 mandates. Should CorpoFin buy the shopping center in the first place? What are the prospects for redevelopment? And how to convince Clemence that this is a good deal for us and for her. So I'll go over the first mandate, which is, should CorpoFin buy the shopping center at the current price? To do this analysis, we did a standalone value of Polaris through a discounted cash flow model. We'll walk you through our main assumptions here. So the first assumption was in terms of the revenue growth rate. There was a spike in 2020 due to demographic trends. So for example, new families arriving in the region, new interest in that shopping center. We think that is positive, but it's not likely to happen again in the next few years as the population kind of settled down and the mall is really implanted in the community. So we decided to project revenue in line with demographic growth inside of the region that you're in. The second assumption we did was in terms of the expenses and basically the margin of SG&A. We said in 2019 it was 51%, then it dropped to 46% in 2020. We think that because you didn't anticipate the fact that there were going to be that jump in demographic growth, that's why the revenues, the expense, were not as high as before, but they're kind of lagging behind and they're going to resume at historical margin after that. And then lastly, we're able to go to our unlevered free cash flow schedule. Again, we'll walk you through the main assumptions. The first one we did was maintenance capex, meaning the mall stay as is, the parking stay as is, no new acquisition or new development is created because we didn't feel comfortable forecasting these acquisitions, especially as we talked with Clemence. She mentioned that she wanted the mall to stay as is. Next, we're able to derive stable and levered free cash flow for the 5-year time period and then calculate our terminal value, which we're going to see in the next slide. So basically at the left, you have our discount rate. We'd use a classic WACC formula. And the main assumptions we did here were in terms of the risk premium. So the risk premium, first of all, in terms of small size, obviously, Polaris is a small development center that is only concentrated in one area. So there's definitely a risk associated to that. The second one was in terms of the industry risk. As Benjamin mentioned, there's a lot of threats from e-commerce, and brick and mortar is really on the declining trends. And we wanted to encompass that in our model, and we found the best way to do it was in terms of the discount rate. Lastly, in terms of valuation, we did two main assumptions to kind of cross-check and do a sanity check to ensure that we had a range of outcome for what the company was worth. So in terms of terminal growth rate, as mentioned before, we went with the demography. So about 1%, this is the population growth in that area. And then for the exit multiple, we used the one that actually Clemence used. So she mentioned that she wanted to sell her property for $14 million. And basically, we compare with the EBITDA of the last 12 months, and we found that she wanted to sell at basically 4.5 times EBITDA. So we decided to also next sensitize our WACC as well as our terminal growth and our exit multiple assumptions. So in the first sensitivity table, we see that we arrive with a comfortable range of about 20 million to 25 million worth for Polaris. In the second sensitivity table, we did WACC against exit multiple. And again, we find a range that's slightly lower, so 15 to 20 million for the company. So now we have a dilemma. If we look next, you're able to see that for the exit multiple, we find 15 to 21. For the EQV, so for the terminal growth, we find 18 to 24, but Clemence is only asking 14. I mean, that's good for us because that means this is a positive NPV positive project. So we decided to do a 14 million bid as a first offer. We're willing to go up to 16 million. We'll explain why later, but basically our first offer is the price that she asked. But we know there's a lot of competition. This is a prime location. Margins have been expanding. There's growth in the community. A lot of bidders are going to be on that company. And we know that to win, in order to win, we'll have to appeal not only to Clemence's financial acumen, but also to our emotional side and, take into account the story of how Polaris was built. And that's why we divided our 14 million consideration in two buckets. First of all, there's the cash consideration. Of course, she wants to sell. She's 80 years old. She worked all her life to build that construction. So she wants to be rewarded, and we totally understand that. But then where we put our twist is for the equity sweetener, that's going to be $1 million. And you may ask, why are we putting that equity sweetener? Well, we understood the story. We talked with Clemence, and we know how much this land means to her. And we know that her father giving that land to all of her 10 children basically shaped their life, shaped their career, and shaped, they really have an emotional attachment to it. And we know that Clemence would want to do this also to her children, to give basically her children her heritage and the value of her hard work. And that's why we added it here. So she could pass those shares on to her children next. And also, even if the cash is a little bit lower, that even if it's only kind of 7% of the offer price, we know that we are issuing dividend. So she's able to get kind of an additional income stream for her retirement, which we think is always nice. So next, we're going to be seeing the deal financing structure. So here you have a basic sources and uses schedule. So in terms of sources, we're going to use cash, debt, and equity, as mentioned. And basically, that's for the 13 million in cash and the shares that she's going to be able to pass on for her children. So to find the amount of cash, so about $1 million, we took into account three considerations. First, obviously, there's need to be some cash left for operations, to pay receivables, to kind of be able to operate. The second one was cash left for renovation. And Etienne will go into more details about that, but basically, we have some plans for the land, and we want to be able to commence water right away. And lastly, we want to make sure to have some cash left for the dividends because we take into account our shareholders. So the cash is the cheapest source of financing, and basically that amount leaves enough to cover the three considerations. In terms of debt, of course, we want to utilize Polaris' excellent balance sheet that doesn't have any mortgages, but has a lot of tangible asset to pledge as collateral. But we want to respect Clemence's financial discipline. So basically, we decided to use 12 million of debt, and that's basically going to lower the average cost of capital for that project, which is going to lower the ROIC threshold for our future project on that land, as well as increase our return on equity. Our final debt to EBITDA is 6 times. We understand this is kind of at the limit, at the maximum, but we're confident that we're going to have the capacity and the cash flows to be able to repay our debt, especially as our debt coverage ratio is 1.25. Again, on the low side, but this is an acquisition and this is the first step in a big expansion project in Canada. And we also have some flexibility, for example, with our dividends. In terms of equity, we didn't want to have excessive dilution, and that's why we have only 1 million shares worth of shares are extended. So that's about less than 10% of CorpoFin as a whole. And as mentioned before, it allows Clemence to give her children part of her heritage, which is extremely important, and to kind of do similar thing that what her dad did to her and basically shaped her life in the first 80 years on this planet. And lastly, of course, there's a dividend stream for retirement that is, kind of a sweetener on top, especially as she's going to that older age. So this is the first mandate, and I'll pass it on to Etienne for the second one.
All right, so what are the mandate is, as Benjamin told you before, brick and mortar kind of slow down a little bit in terms of growth, and there's many risks associated with it. So if we go on, we can see that we have a plan for the future of the shopping center while keeping it as heritage, but kind of putting it on a twist to ensure that the product is very viable and maybe even increase the experience as a whole when the people from that town will be able to go through it. So what we want to do is basically want to make sure that all the basic needs that are currently in the shopping center will stay as it is. But for the experience, we want to make sure that we focus on community events like cinema, spectacle, food court, but also build on some condos onto it to make sure that the community's bonding is going to be pretty strong and we're going to keep it in all tied together. So for the financial, how we kind of look into it, if we go on, we can see how we explain our assumptions. So what we did is, first of all, when we going to create those condos on the parking lot of the shopping center, we'll have to adjust the revenue made from the mall, since around 20% is going to be left over for how much we want to implement those condo on that parking lot. So on the first step, we kind of merge all those cash flows together and those revenue together. So on this percent, we can see that we have less revenue for the shopping center. If we go on for our second assumption, this is for the down payment revenue, since when we're going to sell those condos, it's going to be in a prime location. So we're pretty sure that we're going to be able to get any down payment in the first 2 years as of from now. And if we go on for the next assumption, we kind of put on the sales revenue that we're going to generate from selling those condo at the total when we're going to be able to collect that cash and when they're going to be constructed till the end. So so next, what we can see is the assumption we did for allocating the cost of those construction that we got that are going to be made. So we kind of split it on onto 5 years, just because at the beginning it's going to be more administrative costs, but then as the construction goes on, it's going to be really more related to the construction basis of building condos onto a parking lot. And if we go on to the next slide, we can see our final assumption. So here's the valuation for all merged together of your company and the shopping center as it is. And if you can see down at the bottom, we kind of did 4 scenarios. So first one we did, it was 50, so just one complex of condos with 2, 3, and 4. So, but what we need to sum up over here is just the fact that our highest enterprise values can be scenario 2, which is about 100 square feet of condos is going to be made on the shopping center. So if we go on to the next slide, we kind of did just a small map to kind of demonstrate to you how we want to set it up to make sure that it's going to be the best way for the community to still be able to get around, but at the same time bring in some new evidence in here. So I'll let Ben kind of go through it for the third mandate.
Perfect. Thanks, Etienne. So finally, the last mandate was to look at a way to convince Clemence for the deal. So we want to make this point clear. This is a win-win deal. The first criteria for Clemence was the tax consideration, and what we offer, as Leo said, with a little 1 million of equity, she's basically going to be able to lower the capital gains, which will reduce the amount of tax that she's going to have to pay. The second criteria for Clemence was the heritage, because as we said before, this is a family business, and it's really one of the core value for this business. So what we offer with the equity, again, is to have some value for the future generations, and this will pass on in the future generations. The final criteria is culture preservation. We want to make it clear here that FinCorp is also a family business that was created by brothers. So the value of family and community is also very strong for your company as well as for Clemence. So overall, it's a very great fit in terms of values, and this should convince Clemence to go on with this deal. The final part of the presentation is to look at how we're going to implement this plan. First, we have to look at the risk and catalyst and mitigants for this deal. Of course, one important risk for you as a US company is the exchange rate, how you're going to have to convert between CAD and USD. And the potential mitigant is to use a hedging strategy using futures. A second important risk is the competition in terms of e-commerce. But we want to make clear that we want to focus on the need to socialize of everyone by creating events, like Etienne said, with spectacles and everything, where people are still going to need to come to a certain place to socialize with everyone. The final risk is in terms of retail technological innovation, but we believe that with the strategy focus on essential and events, this is going to be less of a threat, and that in the future we could also consider using some innovation to improve the company and also reduce the costs. So in terms of the implementation, the first phase, we divided the implementation in 3 phases. The first phase is really to acquire Polaris Shopping Center in 2021. Then over the next 3 years, we want to do the integration in the local community, organize different events, and really make a very nice community where we have a business that has values that really are in line with the community. In terms of the second phase, we want to do the condos construction over the next 2 years. Also, we're going to have the down payment reception in 2021 and 2022. And for the final phase, we want to consider retail technological improvements as of 2023. This is going to be very important. We could use like automation and different kind of technologies which are going to help us to reduce the cost of the company and improve the margins, and also very grow in line with the industry trends. The final step would be to consider new acquisitions in Canada or in the US to really make this company grow and continue with all of this success. So we want to thank you for listening, and we will now open the floor if you have any questions.
So thank you for your time. Great presentation. I have some questions for you. Maybe can we go back to the slide with the evaluation of the Polaris sensor, please?
This one?
I think it was well, with the price. So with I agree with your assumption. I think it makes sense. I think the other one, the next one, with this here, yeah, okay, perfect. So if my understanding is correct, asking price 14 million, right? You did two scenario, one with the terminal growth and the other one with the exit multiple. We have a value way over 14 million, right? And I think that in another slide you said we are ready to pay 16, but not more. And what is the reason behind that? Because real estate, you know, it's a competitive market, and probably that some other buyer will be interested to offer more than 16. So we just want to be sure that we will not lose the deal because it seems pretty interesting.
Yeah, definitely. And this is definitely something we took into account. The reason why we don't go over 16 is simply because of the existing leverage of CorpoFin. We thought that with 16 million, that was basically the limit. Our leverage would be way too high and would potentially breach covenants that we already have on our existing debt loan, as well as it would increase our cost of debt. And we would kind of go past that. If you see kind of weighted average cost of capital as a U curve, would go past that optimal point. So that's why 16. And we think we totally recognize that this is a very competitive market and that 14 million is an attractive deal for Polaris. And that's why we added the equity sweetener. We think this is going to both appeal to Clemence financially and kind of emotionally, or just kind of on a more kind of a family side of thing. And combined with the project that we have for Polaris to create a community to focus on basics and experience, we think that would make the compelling argument for our bid.
Yeah, perfect. Thank you. Good answer. And also, I have maybe another question. Can we go to the slide on the financing strategy to acquire the company here? We see that the usage of debt is pretty high, 12 million out of 14. We know we already have a big leverage here in the company. So what kind of partner you think will accept that? Is it standard partners who will need to go see maybe sub lenders to be able to acquire the company?
Yes, for sure. So I think in terms of the debt, we'll definitely need kind of a syndicate of people, if you will. We know that you have great relations with American banks, for example, but since this acquisition is your first in Canada, you'll need to create those new relationships. And we think this is a perfect kind of proxy for it in a sense. So I think the first tranches of debt could be financed via debt and kind of more secured, because they're going to be pledged against very tangible collateral, meaning, you know, buildings, condos, things that have value, even if we need, for example, to liquidate in a very disastrous scenario. And then for the higher tranches, obviously, that's going to be more, I guess, speculative, if you want to use that word, meaning, of course, maybe banks are not going to be interested, but we think investment firms, for example, I'm thinking of, you know, whether it be pensions funds like Ivanhoe Cambridge or PSP, or even more kind of private equity firms that are used to work with these kinds of high debt, high leverage situations through leverage buyout, and that have also operational experience to optimize the business to pay down the debt cost. We think that would be a nice way to structure and create relationship at the same time.
Perfect. Thank you.
Guys, congratulations. I just want to hear a little bit more about your equity sweetener. How would you do it? So you're talking about 1 million of equity to the grandchildren. What is my question is it like CorpoFin equity, or how do you manage this equity, and where does it come from actually?
Yes, for sure. So this equity comes from CorpoFin. It's about less than 10% of our total shares. So nothing to kind of be scared in terms of ownership. It's also going to be very passive equity, so no real voting rights. We think that, but we're going to still kind of listen to, for example, the wish of our grandchildren, but it's going to be more of a partnership to kind of unlock shareholder value than really kind of frictions on the board and something that we're not looking forward to. And also this is going to be included inside of the kind of stream of dividend that we already are kind of using for our partners. And also there's going to be a kind of an option inside of the equity sweetener that if, for example, her or our grandchildren want to sell the equity, we would be able to match the bid of whoever is trying to buy it. Meaning that if we think that the bid is too low and that the company is underpriced, we'll be able to recuperate 100% ownership in case we need it. But we think that's kind of the best of both worlds, and she's going to be able to pass it on to her children and grandchildren after that. And we think, you know, we're eager to do that partnership.
Great. And regarding the deal financing, you're right now mostly directed through debts. I just want to know how did you think about your weighted average cost of capital for the project? I think you put 66% on the debt side. So why did you choose 66% of debt on your weighted average cost of capital?
Yeah, for sure. So the main reason why is because we think there's a lot of synergies to be unlocked in that deal, both in terms of revenues, costs, but also financial synergies. And we know that CorpoFin is a really higher is a bigger company than Polaris. So merging together, we think the deal terms are going to be more lenient. And the way we thought about it for the weighted average cost of capital, we used it as kind of looking at a company as a whole, as well as looking at comparable on the market to think about what would be the optimal leverage. And then we calculated our WACC with that. So even if right now, obviously the debt is pretty high, we think that eventually in the next few years, for example, as Etienne mentioned, we're going to receive a lot of cash for a down payment. Sure, that's going to take into account the construction of condos, but we think debt repayment is definitely one in our priorities. And it was one of the priorities as Clemence as well. You know, she had a very strong financial discipline, and that's something we want to implement. So that's how we thought about our weighted average cost of capital and how we would discount these cash flows, thinking about the broad company.
Great. And you talked about your synergies. I'm just curious about did you included some synergies? Maybe I missed it in your presentation of your DCF, but I just want to know which synergy did you included and why?
Yes, for sure. I mean, I'll jump on it, but Etienne, if you want to add, go ahead. So we think there's three main factors of synergies. Obviously, the first one in terms of revenues. Of course, there's revenue diversification for a company. You're more targeted to the Northeastern. You're making that first step into Canada. You're a new player. That could be a source of diversification. For example, a hedge against different economic events in both geography. I think there's also an opportunity for cross-selling, meaning that people, if we build condos, those people are going to be, attracted to the mall because we're going to offer basics and experience, and that's something they can't get online. And so there's definitely been some cross-selling there and an increase in revenue. There's in terms of expenses, as Benjamin mentioned, we're going to thinking about optimizing costs, whether it be for the construction, have economies of scale in terms of the materials we're going to use, or also in terms of the businesses we want. We're going to have, if we're a bigger company, we have more negotiating power and we're able to charge, for example, higher per square feet. And then lastly, in terms of financial synergies, that was something that was extremely interesting. And I think one of the main points that we wanted to mention, and thank you for bringing it up. First, in terms of cost of capital, I already mentioned that. Also, in terms of taxes, we noticed that Polaris only paid 17%, which was lower than our tax rate, as well as the tax rate, in the comparable industry. So we're eager to learn more about it. And we think that, for example, if we kind of change kind of legal structure, even only for those cash flows, would be less taxed, more to the shareholder and stakeholders. And so these are kind of the three buckets we thought of, and we thought that was a great deal for that.
Great, thank you. And maybe Cal, do you have some question? We have, I think, 1 minute left there.
No, well, I mean, just a small question. Good presentation, guys. You were talking about a bit of some R&D post-acquisition. Just wanted to know a bit what kind of proportion of investment you guys had put on there when you were talking about technological improvements. What kind of reserves do we have on the project to put that forward?
Yeah, for sure. Okay, 30 seconds, I'll jump on it. Benjamin, if you have anything. The main R&D we're looking at was autonomous store. And that was based because we saw at the Eaton Center, they inaugurated their first kind of shopless, without people basically experience to just go in, pick up your stuff and go out. We kind of see it as a pass or fail, meaning that if that does well, we're willing to expend more on it. But for now, it's kind of going to be a small reserve. We're going to see how that fare. If it's successful and, for example, we have demand in our community, we're going to spend a higher proportion on it, especially if it gets more mainstream. Usually R&D is going to be lower. There's going to be more offering. But that was the main technological improvement we thought that would be interesting.
Perfect. Thank you, Leo,
Great,
for your answering. So the question period, it's over. So we'll say thank you to the participant and wish you good luck. So you can leave after say goodbye to the judge.
Awesome.
Thank you, guys.
Merci beaucoup pour
Thanks,
votre
guys.
temps.
Yeah, merci beaucoup.
Ok, bonne journée.
Merci, organisateur.
Good job.
Oh, je sais pas que je parle en anglais encore. Ça sera pas bien long. Ah, c'est Antoine Bouchard qui est rendu le host du Zoom.
Faut que j'arrête le live, c'est ça? Non, attends, je te mets.
Ouais, s'il te plaît, si tu peux arrêter le live. Je sais pas pourquoi ça a changé, mais
Normalement,